Okay, so if you would turn to page 187 of your textbook, and we're going to look at problem P3-42B. Okay, and in this problem we're going to journalize some adjusting entries, and they're going to be very similar to a homework problem you have in my accounting lab. The instructions say that Lindsay Landscaping has the following independent cases at the end of the year on December 31st, 2014. Part A says each Friday, Lindsay pays employees for the current week's work. The amount of the weekly payroll is $6,500. So weekly payroll is $6,500, and this is going to be for a 5-day work week. And this year, December 31st falls on Wednesday, so that means on December 31st we've incurred 3 days worth of payroll. We want to take our $6,500 and find out how much payroll costs each day. So 6,500 divided by 5 days is going to give us a payroll expense of $1,300 per day. And we had Monday, Tuesday, and Wednesday, 3 days. Means we had salary expense of $3,900. And we haven't paid this salary yet because we have payroll on Fridays. But because it's the middle of the week, we have incurred it, and so we will record it as an adjusting entry. So on December 31st, we can record salary expense of $3,900 and a salary payable of $3,900. Okay, this was part A. In part B, we're given a T account for prepaid insurance, and it says that at the beginning of the year, the balance in our T account for prepaid insurance was $5,500 January 1st. Okay, the problem says that Lindsay prepays a full year's insurance each year on January 1st. So the policy is for 12 months. And we want to record insurance expense for the year ended December 31st. Okay, so since 12 months have passed between January 1st and December 31st, we don't have to make any calculation because we've used up all of our policy. All we need to do is move this $5,500 from our prepaid insurance account into our insurance expense account. So our adjustment entry is going to be a debit to insurance expense for $5,500 and a credit to prepaid insurance of $5,500. Okay, so this would leave us with a zero balance in our prepaid insurance account, which would be correct because we've used up all the policy. Okay, let's move on to part C. Let's see, in part C, we have the beginning balance of supplies was $4,200. Alright, so I think I'll make myself a T account here. T accounts can be pretty useful for breaking down problems. And we purchased $5,100 worth of supplies, so that would have been a debit entry to supplies. And the supplies we have on hand at the end of the year are $2,400. Okay, so we know our ending balance in supplies has to be $2,400 because it's all we have left. Alright, so that means we're going to have to make some credit entry over here that reduces this balance over here. Let's see, this is $4,200 plus $5,100. Well, that would be $9,300. So clearly there was some usage of supplies, and in order to get from this balance to this balance, we have to make a credit entry. Okay, so $9,300 minus our $2,400 is going to leave $6,900 worth of supplies that we might use during the year. So our adjusting entry is to debit supplies expense for $6,900 and credit supplies for $6,900. In Part D says Lindsay designed a landscaping plan and the client paid Lindsay $9,000 at the start of the project. So we know at some point we got cash for $9,000. Then it goes on to say that Lindsay recorded this amount as unearned service revenue. So let's stop right there. When she received the cash, the entry she made was to debit cash for $9,000 and to credit unearned service revenue for $9,000. It goes on to say that the job will take several months to complete, and Lindsay estimates that the company has earned 70% of the total revenue during the year. Okay, so this is currently all sitting in an unearned service revenue account, and we want to move 70% of it to our service revenue account. Recall that this is a liability account, unearned service revenue, but we actually want to put 70% of this revenue on our income statement as actual service revenue. So 9,000 times 70%, 9,000 times 70% is going to give us $6,300. Okay, that's how much revenue we want to recognize. So our entry to do that is just going to be debit unearned service revenue for $6,300 and credit service revenue for $6,300. Okay. And then finally, Part E says that we have some depreciation expense. Let's see, we have depreciation for the current year includes equipment depreciation of $3,600 and trucks depreciation of $1,400. So it says to make a compound entry. So on December 31st, here's our adjusting entry for depreciation. We're going to make debit entries into depreciation expense. That's our income account. We're going to make one for equipment and one for trucks. So our depreciation expense for equipment was $3,600 and our depreciation expense for trucks was $1,400. And then we have to credit each accumulated depreciation account. So accumulated depreciation equipment and then accumulated depreciation trucks for the same amounts, $3,600 and $1,400. Okay, so remember that these two accounts, they're expense accounts, so they show up on the income statement, but these accumulated depreciation accounts, they're contra asset accounts, and they show up on the balance sheet. So hopefully you'll be able to understand your homework problem and follow the same steps as we did in this one.